Good day, everybody, and welcome to this month's edition of our Sustainability and ESG training and webinar. We are continuing our series on the Greenhouse Gas Protocol. This month and also next month, we're looking at measuring Scope 3 emissions. So today we're looking at the upstream emissions, and next month we'll be looking at the downstream emissions. You will know that in previous months we've looked at Scope 1 and Scope 2, so we're just continuing on that journey. So welcome to the webinar. We hope you find it interesting and insightful. And as always, I'm joined by Byrne from our office here in Melbourne. So good morning, Dylan. Good to see you.
Morning, Aletta. Good to see you too, and thanks for dialing in, everyone.
All right, so that is just the contact details for Dylan and I. If you need any help around carbon accounting, please feel free to reach out to one of us and we would love to help you. Carbon accounting, and especially measuring your Scope 3 emissions, really complicated. We try and give you a flavor of that today, but an hour is not enough to teach you each and everything. It's really just trying to give you a bit of a flavor on what we're talking about. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. The webinar series that we're talking about, it's the second year of this webinar series. For the last few months, we've been focusing on the Greenhouse Gas Protocol. So today we're looking at Scope 3, the upstream emissions, next month downstream, and then in December we look at decarbonisation strategies. So just a reminder to register for those. And towards the end of November, early December, we'll send out invitations for our webinar series for next year. And I want to say up front, if you've got specific requests for sustainability webinar topics, please send it through to Dylan and I, and we will try and schedule something specifically for you. So we are thinking about what topics at the moment, and we're doing a bit of planning. So we would love to get your feedback. Today's agenda, I would like to start with some of the latest developments, because every month there's latest developments, and this month no different. Then we'll look at a recap of our previous greenhouse gas webinars, do a quick recap of that, and then we'll move on to Scope 3. So we'll look at the types of data, we'll look at some of the Scope 3 supply chain challenges, we'll look at collecting Scope 3 data, and then a reminder of the tools and the resources we have available and how we can help you. So let's start with the latest developments. Now, two big developments that happened in the last 2-3 days. One is around the European Sustainability Reporting Standards. So the scrutiny period for the European Parliament and the Council ended on the 21st of October, so that was on Saturday, without an objection. And that means that the European Sustainability Reporting Standards, ESRS, have been finalised and will be brought into the EU law. These European Sustainability Reporting Standards, just as a reminder, consist of 12 standards, where at the International Sustainability Standards Board, we only have IFRS S1 and S2 at the moment. The European Sustainability Reporting Standards, they already have 12. So yes, they've got climate change and the general requirements, but they also look at workforce, they look at supply chain, which is somewhat what we're looking at today, the emissions through the supply chain. We know that going forward, the ISSB will look very closely at these 12 standards and try and push them out internationally fairly soon as well. So it gives us a good idea of what's on the way. So the Delegated Act for these European Sustainability Reporting Standards was adopted by the European Commission on the 31st of July, but then it had to go through a scrutiny period for 2 months. And we've got a publication, and I've got a link there to the publication. So if you want to read a little bit more, about European sustainability reporting standards, please look at that. There's, I think, two reasons you would look at that. One is to give you an idea what we expect to come internationally and in Australia over the next couple of years. And two, if you have European suppliers, if you have European customers, or if you're part of a European group, this would be important information for you to look at. So that's the first development. Then, closer to home, this is a big event. Actually, on Monday this week, I think they knew Dylan and I had a webinar today. So they kept it till Monday. And on Monday, they've issued, or the AASB has released exposure draft EDSR1. So it's Australian Sustainability Reporting Standards, disclosure of climate-related financial information. Now, this ED is available for comment until Friday, the 1st of March next year. They've given us a long comment period because we lose so much time over Christmas in January in Australia. So people can have a look at this. Interesting, it's a package of standards. So EDSR1 consists of 3 draft Australian sustainability reporting standards, which are based on the ISSB standards. So the first one is ASRS 1, the general requirements for disclosure of climate-related financial information. Interesting, it's based on IFRS S1, but as I've underlined there, it's got a scope limitation to climate-related financial disclosure, which is an interesting thing because IFRS S1 is saying that entities have to do a materiality assessment or a stakeholder engagement and determine which topics are significant to their stakeholders and their users, and then address that in their disclosures. Here in Australia, they're making it very clear that we're only looking at climate-related disclosures at this stage. So we're not considering whether workforce and diversity and modern slavery and all those other things are significant or not. So it's quite a limited scope compared to IFRS S1. And then ASRS 2 is based on IFRS S2. And that's the baseline. It uses IFRS S2 as the baseline. And then there's a ASRS 101, references in Australian sustainability reporting standards. So it's really just the service standards to pull together everything to try and make it easier to say, listen, this is the non-legislative documents that we've looked at in Australia and globally develop it. So, you know, it's more of a reference document. You'll see that our Corporate Reporting Insights newsletter will be published tomorrow, and also our Sustainability News will be published on Friday. And both of them include a little bit of an analysis of this EDSR1. And the team did a great job. When they saw it on Monday, they quickly did a bit of work and wrote an article to kind of give you a high-level overview, but we'll explore it over future months. And if you've got feedback, again, please let us know. We'll be putting a comment letter in on behalf of BDO Australia, and obviously we would appreciate your feedback. So that's Australian developments. The other thing in Australia that we're really waiting for is Treasury to come out with the application of these proposed standards. We know we had the first consultation in December last year, the second consultation at the end of June. They've looked at all the comment letters, and imminently we're expecting a release of who these standards should be applying to, the Group 1, the Group 2, and the Group 3 based on size, and when does the reporting become mandatory. So again, watch this space. As soon as we have it, we'll communicate that with you. Then a bit of a reminder, in the latest consultation paper in June, Treasury created 3 groups. So Group 1, real large entities, and it doesn't matter whether you listed, private, etc. If you're large, based on revenue, assets, number of employees, you have to do certain mandatory reporting, or that's the latest proposal. And then there's group, and the initial reporting would be 31 December 24, if you've got a 31 December year end, or 30 June 2025 if you've got a June year end. So it's very soon. For entities with a 31 December year end, they've got about 14 months before they have to report. And that includes your carbon footprint. And then for Group 2 entities, it's 2 years later, and Group 3 entities another year later. So we have put together a best practice roadmap for those Group 1 entities on how they could look at the measurement of carbon footprint, climate-related disclosures, and also IFRS S1. So, you know, and how they can phase it in over the next year or so. The green blocks is when it's mandatory, and the white blocks is when we're getting ready. So that's just an idea. We will also share in due course our best practice roadmap for Group 2 entities and Group 3 entities, of which I've got a draft on my table at the moment. So that's just a reminder. If you want to discuss how you can get ready and what a roadmap looks like and how we can assist you, please reach out to Dylan and I or any of our sustainability team members. Right, let's get back to the greenhouse gas protocol. And let's just put it in perspective before we look at Scope 3. And let's do a bit of a recap of the previous greenhouse gas protocol webinars. So first of all, we've said in the past when we looked at Scope 1 and Scope 2 that there's certain steps in identifying and calculating emissions. So step 1 is to identify the sources of the emissions. Then in step 2, you select your calculation approach. In step 3, you collect your data, which can be very time consuming, especially in Scope 3. And then again, a very difficult aspect is choosing appropriate emission factors. So having the data and matching it up with appropriate emission factors is very difficult, and that's where software is often somewhat useful. Step 4, you apply the calculation tools or the software, and in step 5, you roll it up to a corporate level. Now, these 5 steps we've used for Scope 1. We've used it for Scope 2, and we will also use it for Scope 3. The process stays the same. Then we've also looked at a basic equation on how we do the calculation, and we said you look for your activity data, you multiply it with the appropriate emission factor, which will give you your tons of emissions, and then you'll multiply your tons of emissions with your global warming potential to get to a carbon dioxide equivalent of emissions. Although there's 7 different emissions that we're looking at, ultimately in order to add all of this together, we take it to a carbon dioxide equivalent. So we still use the same approach and the same equation. Now, when we looked at Scope 1, we said there's 4 categories in Scope 1. There are stationary combustion, mobile combustion, fugitive emissions, and process emissions from physical or chemical processes. And we discussed what would primary data look like for each of those categories, but also what could secondary data look like, and some examples of how we do the calculations. And remember, Scope 1 emissions are direct emissions from assets under our control. And that's not just legal ownership, but it's also control, so where we lease the assets, for example. And then when we go to Scope 2 emissions, these are indirect emissions, but they've got their special place because it's around purchased electricity, steam, heating, and cooling, which in Australia is basically purchased electricity. And then for a lot of office-based businesses, Scope 2 is usually more significant than Scope 1. And you know, Scope 2 can be reduced through energy efficiency, conservation, and we discussed how to measure Scope 2 emissions in last month's webinar. We also started to prepare for Scope 3 emissions, and last month we looked at an overview of Scope 3 emissions. And we said there's a difference between upstream and downstream. So upstream, all the emissions embedded in the products and the services before they arrive at our reporting entity or at the gate. and there's 8 categories in that upstream. So there's purchase goods and services, there's capital goods, fuel and energy related activities, upstream transportation, waste generated in operations, business travel, employee commuting, and upstream leased assets. And I would like you to mark upstream leased assets, category 8. It's a little bit of a complex one because the Greenhouse Gas Protocol was actually written before the latest accounting standard, IFRS 16. And it's time for them to update the Greenhouse Gas Protocol because there's some potential inconsistency between the two. So we'll look at that. Then if we look at downstream emissions, so that's after the goods and services leave the reporting entity or leave our premises, that would be downstream emissions, and again a number of categories, 7 of them. So downstream transportation and distribution, processing of sold goods, the use of the sold goods, end-of-life treatment of sold products, downstream leased assets, franchises, and investments. So overall, you know, when we looked at scope 1, we had 4 categories. When we looked at scope 2, it's basically just purchased electricity. However, when you get to scope 3, you've got 15 categories and you push into your supply chain. So this is really complex, difficult to do. So this is a bit of an overview of all the emissions. Scope 1, the direct emissions by the reporting entity. Scope 2, the indirect emissions, electricity, and then scope 3, distinguishing between upstream before it arrives at our company and downstream after it leaves. And at the top, I've got a link to a document, the Corporate Value Chain Accounting Reporting Standard, which includes this diagram and a number of the diagrams that we'll refer to today. So if you don't know where I get the diagram, that's the link. It covers all of them. So the scope 3 emissions, really we look at 2 documents. They are lengthy documents. There's the Corporate Value Chain Scope 3 Accounting and Reporting Standard, but then going with it is the technical guidance for calculating scope 3 emissions, and there's examples, worked examples in there. The technical guidance, if I remember correctly, is 185 pages. So this is definitely not light reading. But these 2 documents together would give you a good idea of scope 3 emissions and measuring scope 3 emissions. When we look at scope 3 and these 15 categories, usually one of the first questions clients would ask is, how do we identify our relevant activities? Because remember, you have to identify your activities and then you look for the activity data for those activities. So you have to start with, what are the relevant activity data? Do we just look at all 15, or how do we select the ones that we'll be focusing on? The other thing is, if one particular category makes up 90% or 95% of your, or expected to make up 95% of your emissions, you'll put more focus on that and need more accurate data. So how do we do that? So we cannot look at all 15 categories to the same degree. And there's a table in the document saying this is the criteria to consider. And this is judgment. And the important thing, as soon as you apply your judgment, similar to accounting, when you apply your judgment, it is to document the judgment. So the auditors can have a look at it, of course, but also that you can include it in your disclosures. So the things to think about is the size. If you look at the different activities in the different categories, you know, do they contribute significantly to the company's total anticipated scope 3 emissions? So remember, we don't know what scope 3 emissions are yet. We haven't measured it yet, but we're trying to get a feeling for which activities, which categories we should focus on. So this is anticipated scope 3 emissions. So it's the size. And then we look at influence. There are potential emissions reductions that could be undertaken or influenced by the company. So if you think there's a category that is big in size, and you can do something to reduce it, that is one to focus on for sure. It's got an influence, and you have some level of control or influence over it. Then we look at risk. So they contribute to the company's risk exposure. So it could be climate change related risks. It could be regulatory, supply chain, etc., reputational risks. If there's a risk, so there's a risk element, we look at that. Stakeholders, what did our stakeholders tell us when we did a materiality assessment or stakeholder engagement? If our stakeholders are particularly interested in certain activities or categories, we have to be careful and we'll have to look at it. Outsourcing. Maybe there are outsourced activities that were previously performed in-house or activities outsourced by the reporting company that are typically performed in-house by other companies. Therefore, in order to get comparability, we have to look at that. Sector guidance, there's quite a bit of sector guidance available. So if everybody in the sector is looking at certain categories and certain activities, in order to get comparable information, we'll have to look at that as well. The second last one is an interesting one, your spending or your revenue analysis. So, if there are certain areas that require a high level of spending or certain areas that generate a high level of revenue, often, not always, I should say, often those high level of expenditure or high level revenue generating activities would correlate with high emissions. So it's not an exact science, but these are all the things we think about. And then a number of other factors. So you can see there's a lot of judgment when we look at the activities, when we look at all the categories in scope 3 to assess which of these categories, based on this criteria, should we be measuring and which of them should be more accurate than others. The standard, interestingly, says you do not have to, and they cannot expect us, and it's impossible, Dylan, you and I will agree, to be 100% accurate on every aspect of every category. And the standard, therefore, allows us to extrapolate, make assumptions, apply our judgment, because we cannot be busy with this forever and a day, right? There's also the timeliness of the information, which is important. So it's an interesting standard to read. And I think often as accountants and as auditors, we expect, coming from financial reporting, we expect very exact numbers and answers. And this reporting standard around scope 3 can be somewhat challenging to wrap our heads around the level of estimation and judgment involved. When we look at quantification methods, and this is similar to what we discussed for scope 1 and scope 2, there are direct measurement. So, that is a quantification of the emissions as such, using, your mass balance or direct monitoring. And we don't see that much. I think that will be a more sophisticated business. The quantification method that we see most is the calculation method. And that's where we look at the activity data, we multiply an emissions factor, and we multiply it with the global warming potential. And that's the formula I've showed you earlier. So there's two critical parts if you use the calculation method. You need activity data and you need emission factors. And you need appropriate emission factors to match up with the activity data. The other thing that's interesting is the standard specifically says that you can use a combination of calculation methods. So companies may use a combination of calculation methods for various scope 3 categories. So different methods for different categories throughout your carbon inventory. But you could also use combination of calculation methods for various Scope 3 activities within each Scope 3 category. Now, sometimes as accountants, we find that challenging. How can I use different methods within the same category? In accounting, we don't do that. We use cost or we use revaluation of property, plant, and equipment, but we don't use both. So I wanted to flag that in particular. The other thing, so an example, for example, within each Scope 3 category, a company may use more specific methods for the activities that contribute most to emissions, because we want to be more accurate for the biggest part of our emissions. And we might use less specific methods for the activities that contribute least to emissions. So, Dylan, I think this is somewhat confronting sometimes for accountants in particular, that we can look at the large part very accurately and the smaller part less accurate, where sometimes we want to get to a high level of accuracy across the whole population.
Mm-hmm. True.
So that is straight from the standard. I thought I have to flag that because it's so different to what we're used to. So using a combination of calculation methods, companies should take practical approaches to reduce costs. Is that interesting? Use practical approaches and to reduce cost and complexity without overly compromising quality. So they acknowledge that we can compromise quality, but we shouldn't overly compromise quality. Can you see the judgment involved? So we have to get this done in a timely fashion at a reasonable cost. And we don't want to have it too complex because there's risk in it being too complex as well. Ultimately, we need to get to high quality information. And remember, in our very first webinar, we talked about relevance and the 5 principles. So it's important that the standard acknowledges this. And the examples that they give us of things that we might do is you would apply more accurate data and more accurate calculations for large contributors, and less accurate data and less accurate calculations for smaller contributions. And then also, you can group or combine similar activity data. You can obtain data from representative samples and extrapolate the results to the whole. And you can use proxy techniques. So these are things that sometimes are a bit confronting. Are we still getting an accurate number if we do all these things? But the standard specifically allows it. And it's about documenting it, and it's disclosing it, what you've done. And I'll give you an example around a representative sample. If you want to do a carbon footprint across a number of, let's say, aged care facilities, as an example, and you do not have very specific information for every unit in the aged care facility, but you've got 10 3-bedroom places and 15 2-bedrooms and 51 bedroom. If you can find some data for a 1-bedroom, a 2-bedroom, and a 3-bedroom, maybe you get 5 of each, for example, and you work out an average, and then you extrapolate it across the whole property or all your aged care properties. So that's ways that we're not, looking for data extensively. We try and get a reasonable amount of data that's high quality, and we extrapolate, and not just extrapolate wildly. There's a basis for the extrapolation based on number of people living there, number of bedrooms, etc. That would have an impact potentially on emissions. So again, we should think about that. How can we reduce cost and complexity, but still get to a reasonable number, true and fair number? Then they also give us some examples of activity data and emission factors. Remember, we want to know what activities we have to measure, which activities are important, which categories. Then we want to find the most appropriate activity data as accurate as possible. remembering not too much scotch, not too much complexity, and then we have to multiply it with emission factors. So this is examples. It could be the liters of fuel consumed. It could be kilowatt hours of electricity consumed. It could be kilograms of material consumed, your kilometers of distance traveled, your hours of time that you've operated an asset, square meters of an area occupied, kilograms of waste generated, kilograms of products sold, quantity of money spent, so a spend-based approach. And you then line that up with an appropriate emission factor. And then again apply your global warming potential to get to carbon dioxide equivalent. So that's just a few examples. So if we move on to types of data, Dylan, this is where it gets really interesting, the types of data we're looking at. Remembering, and I'm not going to call it a shortcut because it's not a shortcut. Remember that we can try and manage our cost, manage complexity, still get true and fair numbers. That leads nicely to types of data. If we use primary data, that is fairly accurate data, accurate calculations. It gives us the best quality emission footprint at the end. So we will always try and use primary data. So it's data from specific activities within a company's value chain. So that is supplier-specific data. So I would say if I buy goods from 50 different suppliers, I would have a carbon associated or a carbon intensity or a carbon factor for each supplier. And I'll multiply it with what I've spent there, for example. So that's primary data, very specific. Secondary data is data that is not from specific activities within the value chain. So we would say we've paid X amount of money towards insurance. And instead of looking at our specific insurance providers and what their carbon intensity is, we just look at an industry average across insurance entities. So you can see secondary data, less accurate. In a number of cases, it's still acceptable. So if you've got the primary data, that's the first choice. If not, you can look at secondary data. And Dylan, later on, when I hand over to you, you'll discuss this across the first 8 categories. You know, what does primary data and secondary data look like across the first 8 categories of Scope 3? Now, some of the advantages of the primary data, you know, if you've got primary data, it will give you a better representation of the specific value chain activities, everything coming through the suppliers. It gives you a better ability to track performance. So if I've got specific data from specific suppliers, and if those suppliers have agreed to reduce their emissions, we can track it, they can report it to us, and we can see how we and our suppliers together make an impact by reducing emissions. It expands greenhouse gas awareness, transparency, and management. Often reporting entities, large reporting entities, will educate suppliers on this is what emissions are. This is what we want you to report. We want you to set targets. We want you to reduce it. And because you've got that relationship with the supplier and they want to keep you as a customer, they would contribute towards this. So a lot of the work that Dylan and I are doing is actually helping reporting entities to engage with their suppliers to go on a journey together. And we know that entities need to do that because Scope 3 is between 80 and 90% of emissions of reporting entities. And therefore, in order to address it and reduce it, you have to work with your suppliers. And that primary data that we get from suppliers will really help. And then it will if we use primary data, it will allow companies to better track progress towards greenhouse gas reduction targets. If we look at disadvantages of primary data, it can be costly, time-consuming and costly, and it may be difficult to determine or verify the source and the quality of the data supplied by value chain partners. So if our value chain partners or suppliers provide data to us, unless there's some level of assurance over it, whether it's reasonable or limited assurance, really hard to know whether it's accurate. And that's why assurance will be coming to emission calculations shortly. Advantages of secondary data. So if you cannot find primary data and you go to secondary data, what are some of the advantages? It would allow you to still measure your scope 3 emissions. So it's not just in the too hard basket. When there's some estimation involved, we can still do it. It can be useful when you account for emissions of minor activities. Again, we're not excluding it, but we're estimating it. It's more cost effective and easier to collect. And it allows companies to more readily understand the relative magnitude of various scope 3 activities. So identify hotspots, prioritize efforts, which of these areas where we've used secondary data would we like to move to primary data? What would that look like? What would we need? Because if you do a calculation using secondary data for a category and it ends up being a fairly big number and substantial for your business, you would say, hang on, going forward, I wouldn't be happy with secondary data. Let's go to primary data. So again, it's better to use secondary data than use no data. So we prefer primary data, but there's also opportunity to use secondary data. Some of the disadvantages when you use secondary data, it might not be representative of company-specific activities. You use an industry average. So if you've got a particular supplier that only uses green energy, you haven't taken that into account, for example, because you've looked at an industry average and you thought that the whole industry in general use or do not use renewable energy. It does not reflect operational changes that's been taken by your suppliers. So year on year, if you just use industry averages, unless the whole industry improves, you wouldn't see the benefit. Your supplier might have improved what they do, but if you use industry averages, it won't be reflected. So it could be difficult to quantify the reductions in emissions, and it therefore may limit your ability to track progress on whether you're reaching your targets. So definitely we would prefer primary data. The next thing I want to look at in the last section before I hand over to Dylan is scope 3 supply chain challenges. So we always talk about supply chain is so difficult. Why? What are the challenges? There are data collection challenges. Now, Dylan and I work with a lot of companies at the moment, and we experienced this actually before this webinar. In the 15 minutes before the webinar, when we logged on, we were talking about these challenges, practical challenges with clients we're currently working with. You're relying on your suppliers and your partners to provide data. You've got less influence over that data collection and the management of the data collection. You've got less knowledge about the data types, the data sources, the data quality. There's a broader need for secondary data, and there's a broader need for assumptions and modeling. So where with scope 1 and scope 2, often within your control, you can collect the data, you can manage the collection of the data. With scope 3, more problematic, more assumptions, more extrapolation, more modeling. So definitely a number of challenges because you're relying on other people to provide the data to you. And especially if there's no assurance, and at the moment there's not a lot of assurance across that data, it's problematic. Other supply chain challenges is if we maybe look at the diagram on the right-hand side in the first instance, if we are the reporting company, we could have 3 suppliers, tier 1 suppliers, so that would be our big suppliers, but these suppliers have suppliers as well. So a reporting company could engage their own suppliers because they want you to stay a customer. You've got some leverage over them. So there's some contractual obligations, and what we're currently seeing, a lot of people are actually written into agreements. If you want to provide goods and services to us, we write into the agreement that we want you to measure carbon footprint. We want you to provide it to us on a regular basis. We want assurance over it, etc. So it's taking off. So the reporting company has some leverage over their customers, their suppliers. Their suppliers, because the suppliers want to continue to be your customer. It's harder to reach into tier 2, and you're now relying on your suppliers who you've educated to educate their suppliers. And then tier 2 suppliers will educate tier 3 suppliers. So I've just tried to explain a little bit of the complexity there. So this is an example of how we prioritize suppliers. Maybe we take all our suppliers and look at the largest number of spend to the smallest spend. And if we can look at the large suppliers, supplier A to I represents 80% of purchased goods and services. Maybe in the first year, we try and get data from them. And we extrapolate it over the whole population. Over time, we can reach to the other suppliers as well. So just to give you an idea how we scale this and roll it out over time. There's also levels of data. There's product level data. So it's a specific product that you acquire. What is the emission in that particular product? Or there could be an emission within an activity or a process or a production line. So it's not that particular product. There's been a number of products produced and it's been spread out evenly. It could be at a facility level. It could be at a business unit level, or it's at a corporate level. So product level data, obviously most accurate. At a corporate level, it's aggregated across the entity. So this gives you an idea. The homogeneous supplier, doesn't matter which facility or which business unit you're dealing with, all of them have low emissions. So if you look at a corporate level emission, that would be fine. The diversified supplier, if you buy a product from business unit A, or if you buy a product from business unit B, it could have an impact on the emission because business unit B and that facility have high emissions. And therefore, you should factor into a higher emission if you buy products that come from that business unit, as opposed to buying a product from business unit A with low emissions. So if you look at that corporate emission for the diversified supplier, it might not be 100% accurate. But again, maybe initially we look at the corporate level and over time we break it down into more specific levels. And that's difficult to do. Some of the challenges for collecting primary data from these partners, you can have a large number of suppliers, lack of supplier knowledge and experience, a lack of supplier capacity and resources to track this. So much cost pressures at the moment and staff resources are limited. The transparency of the quality of the data, sometimes we've got issues around confidentiality and even language barriers if you get the data from overseas suppliers. And there's also, when you look at secondary data, and I think this is important, collecting secondary data and filling data gaps, right? So we're not looking for data from every supplier for every activity. We're focusing initially on the large suppliers. Remember all the criteria we considered. And then this is a continuous improvement game. Over time, we improve the quality of our data. And that's really what this is about. Dylan, the other way that we can fill data gaps, this is something we use a lot, use proxy data and extrapolate. And over time, you would use less proxy data and less extrapolation. So it's again a continuous improvement journey. So we improve that data quality over time. You can read through those 3 slides. I don't want to go to it too much because Dylan would like to look at collecting scope 3 data. Dylan, I'll hand over to you to look at, the 8 categories. We've got fairly comprehensive notes on all 8 categories, and we'll try and cover as much as we can.
Sure, thanks, Aletta. That's been really good. And I guess as you were talking through those issues, I had a couple of thoughts that I might just throw out there before I get into the detail. Just stating again, if you're in the supply chain, your scope 1, 2, and 3 is someone else's scope 3. So keep that in mind. It's not just for your benefit, but it's how that information could be used by someone either side of you in the supply chain. A particular challenge that we're dealing with on a number of clients is where they've acquired a business or an asset partway through the year, and making sure that your due diligence is picking up on the data that you need around ESG reporting and carbon footprinting, because quite often once that acquisition is complete and the seller has sailed off into the sunset, it can be very hard to go back to them and say, oh, by the way, can we get some data on X, Y, and Z because we didn't get it through due diligence. So that's a really good tip just to keep in mind. And just in terms of the primary data and the secondary data, as we look through these categories, I just want you to keep in mind, obviously best practice is using primary data as much as possible, and it's probably more around the emissions factor where you might rely on something that's a sector or an economy-wide thing, and we're seeing lots of carbon audits where that sectoral emissions factor is quite acceptable because we're just not far enough down the process. But try and get that primary data. If you're not using primary data, the risk is that you're overstating or understating because you're not factoring in the volume or the scale of your business when you're calculating those elements of your scope 3. Definitely easy with scope 1 and 2. It's scope 3 where it gets a little bit hazy and difficult to drill down. So these categories are all coming out of the GHG protocol. They're in that overview, the link that Aletta provided. And this one, category 1, is what we call the catch-all category, and it's kind of looking at anything that's not scope 1 or 2 and is not covered by some of the more specific categories as we work through these upstream ones. So we're talking about just general goods and services that we're purchasing, and the other part of the catch-all is that sometimes we'll look at these emissions and we'll say, hang on a minute, isn't that scope 1 or 2? Yes, if it's scope 1 or 2, put it in scope 1 and 2. If it's not, then this is the catch-all category. So we're just trying to make sure we don't have any leakage. And quite often we'll find that even for scope 2 emissions, there'll be a scope 3 element to it. That's if you're looking at the holistic. Just quickly going through these. So just keep in mind, this is the catch-all. If you're looking, I always think of this in terms of my profit and loss statement. And I'm going through my profit and loss statement, my expenses and my overheads, and I'm going, right, okay, that's got a category of its own. I'll put that to the side. It's the rest of the things that are in there that are not covered by a specific category that we're trying to find. And I guess the good news is, there are software packages, there are sources of information where there are quite good emission factors that you can apply to various things. Within this category as well, we're seeing more and more suppliers have done the hard work on their footprint. They understand what their emissions intensity is, or they understand the emissions that are inherent in a supply. So you probably come across this in your own travels, but for instance, if you're doing your carbon footprint and you go to Australia Post and say you're our primary supplier for postage. What's our footprint? And Australia Post, in most instances, will be able to say, here's your footprint, Aletta, you've spent this much money with us because we track it. Here's your footprint. Business travel, quite common to have a specific emission, not a factor, but emission number that relates to what you've purchased through those suppliers. And the other one that was interesting recently was we saw it with marketing spend. And what's happening is typically you spend all of your marketing money with one supplier, they then go and farm the money out. So you've got these centralized parts of the supply chain that enable them to do the hard work. I guess my fear in a way is, because I deal with a lot of medium-sized businesses, is that if you haven't been able to develop that expertise and that knowledge and that data, that you might be at a slight disadvantage to much bigger suppliers who have been and done this process because they've had to for other purposes, and they're now using that information for commercial means. So it's just something to be aware of as you're, particularly if you're in the B2B space. Thanks, Aletta. I think I've spoken most about that, yeah, but just keeping in mind that where you can get the more specific information, the better. Thanks. Category 2, capital goods. This is talking about extraction, production, transportation of capital goods purchased or acquired. We might just skip over to the next one. Thanks, Aletta. So once again, keep in mind, this is talking about upstream. So this is about capital equipment that's coming into our business, and it's excluding the scope 1 and 2. So if you've got a piece of machinery that is diesel powered or electricity powered, then you're going to have scope 1 and 2 from the operation of that. What we're interested in is more the other aspects of the emissions from these capital goods, and to keep in mind that they're used over a period of time. So that's probably a unique characteristic of these capital goods assets. Keeping in mind too, this is where the leasing kind of comes in, because quite often you'll have a capital good that you own outright. That's pretty easy. It's in your balance sheet. You use it. You're looking at the scope 1, 2, or 3 emissions. There can be a little bit of ambiguity there, and particularly when you're looking at whether that asset is leased. We'll park that for a minute. Aletta's going to talk about that in a tick. But it's just also looking at how do we do the accounting for this asset is quite often going to determine how you do the carbon accounting, and we've spoken about that before as well. There's this consistency or this linkage between how we do our accounting and consolidations and that type of thing, and how we then factor that into our footprint and the way that we do the GHG accounting.
Dylan, the other thing that I found on category 2 is some people would think that capital goods do not include intangible assets. So these days with so many clients having intangible assets or software, IT related intangible assets or customer contracts, whatever they are, that would be part of category 2. You know, so it's assets, whether you can touch them or not, that you use over a period of time.
Yep, that's right. And once again, we're seeing the same types of primary data. Information from suppliers is going to be critical with this, because if you're looking at a capital good, you may have no idea what's gone into the production or the manufacturing of that good. The chances are the supplier has, and they're able to share that information with you that then you can factor in. And then looking at your site specific, how do you, particularly where you've got electricity usage and you've got different factors, but not losing sight of the fact of scope 2 trumps scope 3 when it comes to reporting. Category 3 is a bit of a catch-all in a way as well. It's fuel and energy related activities that are not included in scope 1 or 2. And what we're looking at here are organisations that are involved with extraction or production of fuel. So for those entities, they've got scope 3 emissions as well, right? They're not, sure, they might be extracting something from the ground or creating energy, but they've also got their own set of scope 3 emissions that are carved out or separate from the bulk of the scope 1 and 2 emissions for those organisations. And here's a good table. I just keep referring back to these tables because it just gives you so many different breakdowns of things so that you're not having to do too much interpretation for yourself. You can actually look back at these worked examples and seeing whether it's, you know, emissions of purchased fuels or electricity or transmission losses, those types of things. That just gives a really good detail that you can then factor into your carbon footprinting process. There'll be a common theme here that the primary data is to talk to your suppliers as much as possible, get them to help you out. And some of these more complex areas, like, you know, grid losses and those types of things, there'll be information that you can rely upon for the purposes of your calculations. Category 4 is upstream transportation and distribution. This is another one where we're differentiating between scope 1, which would be where we've got vehicles of our own that are used for transportation and distribution. So if you've got a fleet of vehicles that are not electric powered, they're diesel powered or fuel powered, then you're going to have some scope 1 for those. What we're talking about is the scope 3 elements of that, and we're particularly talking about inbound logistics for products that we're, materials that we're buying, or outbound logistics for products that we've manufactured or on-sold. So once again, we're looking at something that's distinct from assets that we're using and creating our own scope 1 and 2 emissions. And quite often these emissions are from a third-party supplier as opposed to our own. You know, we all use external freight operators to bring things in and out of our business. That's the emission that we're catching in this category. Thanks, Aletta. Some of the examples there, air transport, rail, road, marine, storage. Storage is a big one, particularly if you've got clients who manufacture food. There's refrigerated storage that's off-site that they outsource to someone. That's where you would look at those suppliers and say, can you tell us what your emissions are so that we can factor that in? And that could be quite a large one, given that there's electricity and other fuels going into the provision of that service. Another table, we'll share all these notes with you. So I think this is a really important one because you've got that kind of grey area between scope 1, 2, and 3, and that's what we're trying to help you is just to understand that there will be these crossovers, and it's just important to understand the particular type of emission that we're looking at, and having that ability to categorise things and put them in the right box so that we're not double counting or not missing anything. With this one here, and we're starting to see this in some of the categories come through, we've got other ways of measuring. So it's not necessarily a dollar spend. That's the factor that we use for a lot of these scope 3 emissions. But we're now starting to see things like distances travelled or emission factors that are specifically for a supplier. And I guess it depends on where you're transporting something to and from, how you're transporting it. You can't just say if I spend $100 on distribution and transport, that'll be the same for everyone. It's going to be this is one where it's quite specific to what you're doing. So I think this is one where, and the emission number could be quite large compared to some of the other purchased goods and services where, you know, they're quite light on the emission side of things. I think this is one that is probably a bit of a sleeper and needs to be considered in a bit more detail, particularly if you're in that kind of manufacturing, wholesale, trade, lots of logistics going on. This is quite a large one. and certainly a big issue for some of the logistics companies that we've been talking to over the last little while. Category 5 is waste generated. This is a good example of someone else's scope 1 being your scope 3. So obviously we've got waste facility treatments, you've got wastewater, municipal, rubbish dumps, those types of things. Lots of methane, lots of scope 1. This is something where there's quite a lot of sophistication in the market, and people who run these waste facilities have been looking at these for years and years. So this is a category where they should be able to say to you, based on what you spend with us or what the waste that we process for you, here's your emission that you need to factor into your scope 3. Once again, if you're doing some of that yourself, that'll be your scope 1. This is stuff that's offsite, outsourced. It's given to someone else to look after, but this could be quite a large number depending on the profile of your business. So another one just to keep a good eye on. Lots of information here, but as you can see, we're talking about landfills, recycling, waste to energy, wastewater, those types of things. And in some cases, hopefully, there'll be lower emissions because that waste handler is looking at things like waste to energy, capturing methane, recycling, those types of things. And that might be a differentiator between who do we use for that particular service in our business. There will definitely be quite specific information available for this category as well, just given where you are and where your waste is being delivered to and how it's been treated. Business travel is a big one, as particularly COVID lifting, people are getting back into the air, back into face-to-face meetings. This is one where, as I mentioned earlier, quite a lot of travel companies are able to give quite good information. They track the miles of travel, they track the hotel nights, those types of things, and there's lots of sophistication around the emissions factors there. So hopefully this is one where you don't have to do, well, apart from probably doing a little bit of cross-checking and making sure that you are picking up all of the nights of travel, because sometimes you may not use your outsourced provider for some. But we're talking about things that are in vehicles or transport that we don't own. This is off our balance sheet. This is us jumping on an airplane and flying to a meeting. Distinct from employee commuting, we'll talk about that category in a minute. But hopefully this is a pretty obvious one where we're more and more activity. But talk to your travel provider about the emissions factor and the emissions that they can provide you with. Yeah, we just go next one, thanks. Good category there. Just once again, tables just to help you unpack it. This one should be reasonably evident though. The next category 7 is around employee commuting. This is probably fair to say one of the harder ones to do because you don't know everything about your employees and neither are you ever going to know everything about your employees. They're all unique in their own way in terms of how they get to work, how far they're traveling, etc., etc. So what we do in the case of employee commuting is a large reliance on surveys. So lots of organisations would be surveying their staff and finding out a bit of information to the extent that they can then apply these emission factors and rules, if you like, to that. And as Aletta mentioned earlier, we've got extrapolation, we've got analysis. So it might be that you do it once for a subset of your staff, and you can therefore say, well, if it's that much for a quarter of my staff, then I can extrapolate it out. So long as there's some basis for it, you don't just pick a bunch of staff who live within 5 kilometres of work and exclude everyone wider out, or vice versa. But that's one where we can help if you're stuck for how do you actually approach that. there are some good processes there that we can help you out with that one. Typically not a huge component, but I think the other part where this category is very valuable is with our ESG and our social, and just making sure that our staff are feeling like we are switched on to this particular issue and that we're trying to make it easy for them to get to work, but also that we are aware of the emissions that are created. And you've got a nice little balance or tension there between working from home and getting people into the office and the emissions that are created with one and not with the other. Yeah, so that's quite an interesting one, just the way that the whole work environment is going.
Dylan, the other thing I was thinking about when we extrapolate, there's such a vast difference between Melbourne and, for example, Perth or Brisbane after COVID, where in Melbourne we have so many people still working from home, and therefore the balance between how many days in the office and therefore commuting and how many days working from home is very different, I think, in Melbourne still compared to, let's say, Brisbane.
Yes.
So you cannot survey your Melbourne staff and apply it to all your staff across Australia. You know, so again, that sensibility of extrapolation.
And I'll just add one other thing with that is what a lot of organisations will do is they also look at the emissions that are in the employee's home when they're working from home.
Yes.
So they'll even say, you know, have you got solar power? Are you is the gas heater on all day in the middle of winter? You know, those types of things, so that you're not getting you know, a wildly inaccurate number because no one's coming to work, because they're still working, they still have emissions. The office emissions might be lower, but you've got an additional emission through people in work time. We're not interested in what they do in their private time. It's more in work time. Where are they? What are they doing? How do they get there or not get there? That's the bit that we're trying to capture there.
It's really a difficult category, Dylan, because you know people travel different distances. How do you come up with an average, etc.? I find category 7 quite challenging.
Yes, true. Okay, I'm going to hand back to the expert for this one.
So, category 8. Every time when I read it in the protocol, I think we need to update this because we're looking at upstream leased assets, and really they're looking at the old days before we had IFRS 16, which brings all leases onto the balance sheet. So this is in the old days when you were a lessee. If you were leasing a property, you had the ability to use it for 3 years, you pay a monthly payment. None of that ended up on your balance sheet. It wouldn't be a right of use asset, no lease liability, no nothing. There were still emissions in that property though. So they had to bring in a specific category to capture the emissions associated with that property. Now these days, it's very different. When you're a lessee and you enter into a lease, you have a right of use asset, which will be captured under category 2, where you've looked at purchased goods, you've got a lease liability, etc. So looking at leases is an interesting one. The other thing is, when you look at category 1 and you look at assets under your control, you will also look at the assets that you've got the right to use. It's on your balance sheet. So some of it is actually already picked up in scope 1. And then potentially some of it can be picked up in purchased goods and services. So it's everywhere else, but I find it hard to find something in category 8 actually. It will be small bits. The interesting thing is there's a difference between a lease and a service arrangement. And that's an interesting one, because if you lease a vehicle to make deliveries, that vehicle will be on your balance sheet. And therefore the petrol that you use will be scope 1. If you've got an arrangement with a provider to provide delivery services on your behalf, We have to assess, does that arrangement include a lease or not? Is it really just you getting a service, or do you get the ability to direct where a particular delivery truck is going every day? So it's very technical. So it's just to flag that there's this difference between a lease and a service. And all leases are on your balance sheet, it's under your control, and it's got implications for emissions. It's a difficult one to look at. The other thing that I should flag, Dylan, is next month we're going to look at where you are the lessor of a property or the lessor of equipment, and then the rules will be very different. So if you're the lessee, it's on your balance sheet, and it has an impact for your carbon footprint. But when you're the lessor, you still have to think, is it a finance lease or an operating lease? And there are consequences again for your carbon footprint. So it's interesting, again, the interaction between accounting and carbon footprint here.
Yeah.
So I think what we're trying to say is be careful. I think we'll wrap it up with a few tools and resources. So we've got a number of sustainability tools around activation checklist, TCFD, checklist, training. We've got our webinars till the end of the year. We've got our newsletters coming out tomorrow and Friday. And on our website, a lot of information. We've got a new BDO website, so it's looking really cool. And how can we help? Obviously, that carbon footprint measurement is what Dylan and I do. We do reporting, we do strategy, we do assurance over carbon footprints. There's decarbonisation strategy. And there's a bit of a description of our core 5 services. But there's also additional things we do around sustainable finance and sustainable communities, etc. And then a number of key contacts if you want to reach out to some of our partners nationally. Dylan, thank you very much for joining me for the webinar. It's always so much fun. Everybody that's joined our webinar, I hope you've learned something. It is really scary stuff, very difficult, but we've given you some resources and obviously happy to speak to you. I hope you have a lovely day. Thank you, Dylan. Thank you, everyone.
Thank you. See ya.